Okay.
All right. Cool. Looks like we're live now. So let's get started. Yeah, thanks everyone for joining the Blocks webinar today, titled Exploring Bitcoin Staking Today and Beyond. Today we'll be talking about the big basics of a new trend that we've been seeing that's getting a lot of discussion, which is Bitcoin staking. So today on the line we have Thomas Chen from BitGo, Brendan Cito from CoreDAO, Edgar Roth from Kiln, and Willem Shoei from Botanics Labs. I'll let you guys introduce yourselves. Thomas, do you want to kick us off?
Yeah, happy to. Thanks, Carlos. So hey, everyone. My name is Thomas Chen. Been with BitGo for 6 years now. BitGo's brand is synonymous with custody. We've got over 50 billion in assets under custody across 44 chains supported. It's like 800 plus tokens. We actually pioneered multi-sig wallets back on Bitcoin back in 2013. So we've certainly been around for a long time. We're also one of the largest staking providers with over 25 assets supported and billion of assets staked. And just really quickly, for those of you guys who are a little bit unfamiliar with BitGo, we're the company holding on all the assets to FTX's bankruptcy estate, but we actually do a lot more. We're a wallets and market infrastructure company, and that a lot of crypto economies actually rely on. We've got 1,500 plus institutional clients across custody, staking, trading, borrowing, lending, settlement, and much more. And just to summarize, I look after the revenue side of our business as it pertains to the crypto native projects, blockchains, VCs, and also WBTC. So all views, and just of course the disclosure, all views are my own and my beliefs and not those of BitGo. And I hope to share my views from the institutional angle today. Thank you.
Awesome. Thanks, Thomas. Yeah, Edgar, you want to go next?
Sure. Yeah, I'm Edgar Roth. I'm protocol specialist at Kiln. Kiln is the leading enterprise-grade staking provider. So we're the leading staking provider that is not tied to an exchange. We have about $8.5 billion under stake currently. We are very known for running Ethereum infrastructure. We run about 4.5% of the ETH validators, but we've been very interested about new topics such as Bitcoin staking. So very excited for this panel, for this webinar.
Awesome. Thank you. Brendan?
Great. First of all, thanks for hosting. Good to see some familiar faces with the other panelists here. But yeah, my name is Brendan. I'm one of the contributors at CoreChain. Been with the project for a couple of years now. We're a layer one blockchain that is basically secured by Bitcoin, and it's fully EVM compatible. So we really try and take the decentralization and security of Bitcoin, specifically for miners and Bitcoin stakers, with this great composable EVM concept. So it's really easy for builders to come build on the chain, bring their dApps, and enable a lot of use cases that aren't currently possible on the Bitcoin chain itself. We're a leading Bitcoin chain today. As I mentioned, Bitcoin staking's a key part of our consensus. I think we're going to dive into the details of that. So really excited to share some views and help with the discussion here.
Awesome. Thank you. Yeah, and lastly, Willem.
Yeah, great to meet you all. So I'm Willem, founder of Botanics Labs, Belgian. So was happy to go to ECC 2 weeks back. Bit of a mathematics background and cryptography background. So researched in authenticated encryption, broke some algorithms in there. 2 years ago, came up with the idea for Botanics, which is still exactly the same. Basically, in our mind, Bitcoin is the winning money. EVM is the winning virtual machine, and I wanted to build layer 2 EVM on Bitcoin with the whole tech stack running on Bitcoin. Actually, back then, nobody really put together to build a proof of stake on top of a proof of work. So one of the things we did is went deep into the cryptography. I was living in Boston back then, and actually originally was a proof of work maximalist. So this is definitely very interesting. But then realized that if you build a proof of stake on top of a proof of work, the whole thing changes from a theoretical perspective. And so came up with what's now called Spider Chain. So the Spider Chain is a novel layer 2 design that's actually quite unique in its presence compared to all the other layer 2s because it's capable to be fully decentralized. And we come together in a proof of stake where we use Bitcoin staking as the basis for the security of the layer 2.
Awesome. Thank you. Yeah, and we'll dive a little bit deeper into how that all works. Cool. So for a quick outline of what we'll cover, we'll just discuss the basics of Bitcoin staking, discuss the benefits that Bitcoin staking can bring in areas like treasury management, portfolio management, and just giving people like new options for earning yield. We'll discuss current trends and innovation, the future outlook of Bitcoin staking, and then we'll leave some space at the end for audience Q&A. Sweet. So to get us started, I want to just like get into the basics of Bitcoin staking. Edgar, this is something that kind of, when I first heard of Bitcoin staking, it sounded confusing and weird. Bitcoin is famously a proof of work chain. It uses computational power to secure the chain, and that's totally different from proof of stake chains like Ethereum, which require validators to like lock up capital. So can you explain what Bitcoin staking even is?
Yeah, sure. Yeah, I had the same reaction when I first heard about the concept of Bitcoin staking. And actually, when you look at it, it's not that exotic. So in normal proof of stake protocols, what you do is that you have the native asset of that blockchain or protocol, and you stake it to secure the same network, basically. So think of Ethereum. Ethereum is using ETH for economic security. So you lock up 32 ETH, and there you go, you have a validator. When it comes to Bitcoin staking, and actually like there are other protocols in the space that are using the same idea of basically like rehypothecating the economic security of asset A to secure network B. What you do is basically like you lock up asset A, and in the context of Bitcoin staking, it's BTC, to have the role of the validator basically on the network B. So we'll dive a bit more into the details of how it basically comes into play, but this is basically like the big picture.
Nice. Anyone want to add there? I was curious, Brendan, like how does this even work? So I mean, Bitcoin is famously most other proof of stake chains either have staking functionality baked into the protocol directly, or you can kind of create staking functionality using smart contracts. However, Bitcoin has famously limited scripting capabilities and no smart contracts. So can you explain maybe some of the basic mechanisms for how Bitcoin staking works?
Yeah, I'll explain it on core because I'm sure there's a few different approaches, botanics and a few others. So excited to hear what others say here. But yeah, the thinking is basically taking this I don't know what the market price is today, but like $1.5 trillion or so, and using that to as a security budget or security for your chain. So in the sense of core, as you mentioned, there's no necessarily smart contracts, but there are a few scripts on the Bitcoin network. So specifically, we use the check block time verify script, which allows you to basically issue a time lock to yourself in your Bitcoin wallet. And what's great about this is you don't give up custody of your funds. It's basically like time locking them in your own wallet. You specify a length of time you'd like to lock them up. We then run a relayer script that picks up that data. And I should mention when you issue this transaction, you're also choosing a validator you want to delegate to. And you could think of it as like you're basically voting for a validator on core chain with your Bitcoin stake, right? And we're then basically, you could vote for the Kiln validator. And we're basically electing validators each day based on how much Bitcoin has been delegated to said validator. We also have a mechanism that has hash from miners and core stakers, but Bitcoin's a big piece of that. So basically, you're time locking Bitcoin in your own wallet. Again, you have the peace of mind of knowing that it's in your wallet. And then for helping secure core chain, you're earning a percentage of our block rewards. So for us, we have this really sustainable yield that comes for the next 81 years. There's no liquidity mining incentives or games being played. We basically have a budget of block rewards similar to Bitcoin that slightly goes down every year. That's paid to stakers. you're basically earning a percentage of our block rewards for helping secure and vote for one of the validators on the core blockchain. And that's how it works today. We've actually launched this. So I think we're one of the first projects live. We have about 5,000 Bitcoin staked already, about 325 million. It's resonating really well with most folks because you're taking on basically no risk as you're issuing the transaction in your own wallet, and you don't have to give up custody of your funds. So that's a bit of how it works on Core Chain and how we use Bitcoin to help secure Core Chain today.
Awesome. Thank you. Yeah, William, I actually wanted to shoot it over to you and get a sense for how this all works on Botanix.
Yeah, sounds good. Maybe I'll first add on a little bit on what Edgar said on like why Bitcoin staking is so powerful, both from like a security perspective and a society perspective. I think when you look at a proof of stake, the most important aspect security-wise is how decentralized your stake is. We all know that proof of stake, after a while, trends more and more centralized because the same staking asset, over time, the stakers will get a bigger and bigger percentage of that asset. And so it has a centralizing trend, while proof of work is more decentralizing. Now, for proof of stake, if most of the stake is in the hands of the same people, your security is almost zero because those people can basically steal or attack the whole network. Now, the most decentralized asset that there is Bitcoin. And so Bitcoin staking from a pure security theoretical perspective makes actually the most sense because you basically immediately inherit the decentralization of Bitcoin itself. Now, of course, if you use Bitcoin as the staking asset, then of course, one of the benefits is that you can get rewards for it. So suddenly, I think over the last 10 years, so many people wanted to give Bitcoin yield. We've seen a lot of companies fail to do that, and actually, yeah, like a BlockFi basically go bankrupt, and a lot of users getting their funds basically stolen. Now, if you can do that in an open, transparent way with code, that is a total game changer. And so that's in general some additions. I think for Botanix itself, we run on a little bit of a different system. So you've got Babylon and CoreDAO that basically purely does a time lock. So you put your funds in, you log that with a time lock. If you do something wrong, you leak, for example, the private key. Now on a Botanix, we basically actually realized from a cryptographic perspective that if you secure the bridge in a decentralized fashion, you can have the slashing logic on the layer 2. And so we run a Bitcoin layer 2 EVM. And so in the EVM, you will have a staking contract where basically the Bitcoin sits in. And if you are not online or if you do something wrong, you can basically get slashed. So very similar like in Ethereum. And that allows for way more expressivity than when you do it as purely a time lock. And so then that basically increases the security of the proof of stake. So how the spider chain works is we have this decentralized network of multi-sigs. In essence, we want to decentralize the multi-sigs. And so you create a series of multi-sigs where all the Bitcoin actually sits in. But the cool thing is that anyone will be able to join that network eventually. So you can have 10,000 full nodes or 100,000 full nodes. And it's actually fairly similar like in Ethereum in essence. But then the whole thing runs on Bitcoin. And so the staking itself is basically the Bitcoin sits in this decentralized network of multi-sigs. Anyone can participate in if you stake Bitcoin. And that Bitcoin sits in an EVM smart contract in terms of the logic. I went quite deep in there, so feel free to ask some higher level questions. So
yeah, for sure. And Thomas, I saw you unmuted. Do you want to jump in?
I want to kind of summarize this a little bit from the context of what we see that our institutional clients care about, what the reality looks like for them today, the alternatives to, or actually the current setup to get yield that doesn't involve Bitcoin staking and what that looks like. So as everybody stated here, right, Bitcoin, there's limited use cases for financial applications. But what it does have is the robust security and decentralization. So how do we marry this, this with scalability and functionality, right? There's a number of different ways to do it. As CoreDAO, Core Protocol, uses the time lock and how Botanix uses their own bridge, if I get that correctly. And there's other ways to do it. Like we have a WBTC product where people can take BTC, give it to us, wrap it to earn yield, right? So there's different ways to stake the Bitcoin. I think at the end of the day, what could be most interesting for institutions is you have to think about the people behind the institutions, the LPs or the regulation. So the tech might work, but we have to have a right construct of how they execute and how they get the yield in order for them to actually realize those benefits from Bitcoin staking. Today, the way to get yield on Bitcoin is either for an institution to lend it out, right, where it leaves your wallet, or you can wrap it into WBTC for DeFi. On the former, you're taking on counterparty risk, right, as we saw with BlockFi. And on the latter, you definitely have some centralization and DeFi risk. So it all comes down to what kind of risk appetite you're looking to do. But what I'm most excited about is there's just so many. I think the Pandora's box is open for Bitcoin staking, and there's just so many different ways people are trying to figure out how to do it.
Awesome, thanks. And actually, do you want to maybe comment a little bit on how this looks from a user perspective? Do people just like, stake by sending to a specific Bitcoin wallet, or how does this kind of all work? Do people stake for a specific amount of time? What does that look like? Just kind of curious, from the user, what that looks like.
From the BitGo perspective, we certainly hope to achieve a user experience where within your existing BitGo dashboard and the Bitcoin wallet, there's a one-click Bitcoin. It sounds weird to say it, to stake your Bitcoin. And whether it's connected with Core or Botanix or Babylon or whomever on the back end, we still have to figure it out. But we want the experience to be as seamless as possible for the user. Today, without going through a existing wallet provider like a BitGo, I'm just citing what I'm seeing on like Babylon. You can just log onto their website and stake vis-a-vis one of the wallet providers that they have there. I imagine the same for non-custodial setups with Core and Botanix as well.
Yeah, Edgar, actually, how does that look on Kiln? Can people, select which protocols they're securing? How does that all kind of work?
Yeah, so Kiln now supports we support Core on mainnet. So if you go on the Core dashboard, you can delegate your BTC to Kiln. Brendan already went a bit into details into like how that works. It's basically like a time lock. So when you stake Bitcoin on Core, you have to put it in a time lock. You set that time lock, and you'll only be able to redeem your BTC after the time lock ends. You delegate that to a validator on the Core chain, and you of course link your BTC stake to an EVM address or a Core address that will be able to receive and claim the rewards on the Core chain. And so that's how it works for Kiln on Core, but we also support like the testnet of Babylon, for example, and Babylon will have like a different way to make that work, and basically it will be able to split the UTXO in multiple different ways, or it's not exactly clear, but basically like Babylon will enable a way for the Bitcoin staker to pre-sign a message to a function to enable slashing if the validator to which the staker delegates to does a slashable offense. So basically this is like Babylon just puts another brick on top of the other Bitcoin staking protocols to put that slashing component, and that of course comes with some risks there. But yeah, it's just one other way to do it. And of course, like William said, there'll be ways by which we support Bitcoin staking on that is not from the layer 1 itself, but from layer 2s directly.
Got it. Makes sense. And so there you mentioned something important that I wanted to talk about, which is, the concept of slashing, and related to that. Yeah, I guess I want to hear a little bit more about what the trust assumptions are for Bitcoin stakers. What kind of risks are they taking? So maybe actually, Brendan, do you want to kick us off there?
Yeah, happy to share. I think we'll hear a ton of different examples from Edgar, Willem, Thomas. I think they'll probably cover those. But in the way it works with Core is we kind of really consider this a delegated staking method, right? Like delegated proof of stake, delegated proof of work from miners. So the way that we set it up with like the non-custodial time lock is there actually isn't slashing for individual Bitcoin stakers. So to clarify, if you stake or issue the time lock in your Bitcoin wallet, there's no slashing risk for you as a staker. And our thinking around that was, we've kind of heard at a high level some of these like private key exposure risks. We didn't think that that was a risk that institutions or folks with Bitcoin would want to take, first of all. So we didn't really include that, didn't want to include it in the design for that reason. Secondly, our slashing mechanism works again in this delegated system more so that the validator, so for example, Kiln is putting up a bond, right? Like to register their validator, they're putting up a validator bond, which is a number of core that says they're going to behave and act well in this system. And if they do not, they can get slashed and they lose this bond. So there's a large economic penalty for them to misbehave. So that's how our system works, and why we made those decisions. Again, the key thing for that we had thought through was that we'll make the penalty on the validator as opposed to large Bitcoiners trying to due diligence on a ton of validators and try and make a decision on where to put their Bitcoin at size, and didn't think that they'd want to be exposed to those risks. So that went into our design decisions.
Got it. Yeah, that makes a lot of sense. And I know it works very differently on different protocols. Actually, well, I'm curious on Botanics, what kind of risk or trust assumptions are stakers taking?
Yeah, the best way to think about Botanics when you want to think about it from a higher level perspective is that we're almost like an Ethereum as a second layer on Bitcoin, and but we're only connected to Bitcoin, and so the gas fees are Bitcoin, etc. But when you think about the slashing risks, they are going to be fairly similar as like an Ethereum. There's one additional slashing risk is if you would sign a faulty Bitcoin transaction. But the rest of the slashing and penalties are fairly similar than an Ethereum.
Got it. Makes sense. And Edgar, I was kind of curious if you wanted to like speak more broadly into like how it works on some other protocols like Babylon. What risks are stakers taking? What trust assumptions are they making when they stake their Bitcoin?
Yeah, so like I was saying on Babylon, there are a few components. There is the time locking component on the layer one. There is I would say the pre-signing of the potential slash function if a malicious offense were to happen. And there's also like the component where you tell the protocol which validator you choose to delegate your funds to. And overall, what I'm seeing is that most of the Bitcoin layer 2s will likely enable staking from their layer 2 itself. We might also see like similar models as to Babylon so that they can enable slashing from the delegator's funds. But yeah, I expect mostly like if we're seeing like a big Bitcoin layer 2 space, most likely like some of that Bitcoin will need to be bridged to the L2.
Got it. Makes sense. Yeah. So in terms of explaining the mechanisms of Bitcoin staking, I think we've talked a lot about like how it works from a pretty technical perspective. Got pretty deep in the weeds. I wanted to actually also talk about. Oh, sorry, Willem, you raised your hand there.
Yeah, I wanted to add like one big risk. I think that's often overlooked. That comes from the fact that the staking asset of any Bitcoin staking protocol is not a base layer. The big attack risk that you have to take in mind is if you run a Bitcoin staking protocol, what happens if 2/3 majority is being taken over? Like in Ethereum itself, that is totally different because you would have to have 2/3 of the whole base layer protocol. But if you run a Bitcoin staking protocol, that is totally different. And for example, you can think about, for example, North Korea has 100,000 Bitcoin. What if they take over 2/3? What if they take over like 4/5 of the whole Bitcoin staking protocol? What can they actually do? And so that comes back to like how decentralized is actually the Bitcoin staking. And so in essence, especially in the beginning phases, a lot of the Bitcoin staking protocols are at risk of that type of attacks. But that's set apart from like all the slashing, etc. But it is important for yeah, if you would do it on an institutional level basis in a permissionless protocol.
Got it. Yeah, that makes sense. And actually, before we move on, from trust assumptions and security, Thomas, I wanted to like give you the chance if you wanted to mention anything related to what institutions should be thinking about as they're, thinking of potentially staking their Bitcoin.
Well, I would say they care about the yield. They care about where the yield's coming from, how it's generated, whether or not it's real yield. I don't think they're too keen to stake if the reward's in points, right? Until the reward mechanisms or penalties are figured out. And then in working with Kiln, I'm Edgar is probably not close to this, but reporting is massive, right? And the challenge with institutions and when you're staking, not just on Bitcoin in the future now or in the future or any other chain, each protocol is different than the other one. So it's really tough to have one standardization of reporting normalized across different blockchains, sometimes different assets on different blockchains, right, with different providers. So that's the biggest challenge that I see is how do we standardize all the reporting back to the institutions?
Awesome.
We actually
Makes
have
sense.
a product for that. Sorry to cut you, Carlos. We have internally at Kiln, we and something that we provide for all of our customers is something called Kiln Connect, where we actually abstract the complexity of all of the different protocols. So we're used to doing that on the 30 plus L1s that we support at the moment, and we'll also be supporting Bitcoin staking protocols as well.
Awesome. Yeah. Thanks for that. Actually, like Thomas, you mentioned something I wanted to kind of get into next, which is, the actual yields that are coming from Bitcoin staking. So curious to get a sense in terms of basic mechanism, where are these yields coming from? And I know it works differently for different protocols, so we'll kind of like have multiple explanations there. And also maybe what kind of yields can stakers expect now in the future?
Sure, happy to go first on this one. I think this also addresses one of the questions in the Q&A. I can't answer specifically for where the yield comes from or what the yields look like at the moment. It's probably better answered by Brenner and Willem or Edgar. But what I can say that right now, what does the reality look like for institutions, right? The predominant utility of BTC right now is it's a better form of collateral when you want to borrow stables or cash, right? So the game that's being played right now, and from what we're seeing, is people will post BTC to borrow cash. Now, if they're an institution, they're probably trading it or leveraging it up. Or if they're a retail platform, they're getting cash and they're lending it out to their retail clients. The market changes, right? And it depends on a variety of factors, including the amount, the collateral type, the client, etc. But we're seeing BTC being lent out around like 5 to 6% even against staked assets as collateral. So I think the predominant use case before Bitcoin staking is just using it as collateral for cash and stables. But look, if there's a lot of people that are long Bitcoin, if there's a product that doesn't increase the risk and there's trust and understanding of how the yield is being generated, we'll see a lot more demand from institutions.
Yeah, I think we'll all have like some. Yeah, okay. Well, go ahead on this one.
Yeah, I can maybe go next. For us, the answer to where does the yield come from is super easy. You'll have the gas fees in Bitcoin. And so like on Ethereum, you have $5 billion of gas fees rewards every year that accrues back to the stakers. And so for a Botanix, a layer 2 EVM on Bitcoin that has all the gas fees in Bitcoin, all those gas fees in Bitcoin will accrue back to the stakers. So that's very easy form of yield, and it all depends on the activity on the chain. And so the activity will come from a bunch of different things, like the borrowing protocols, lending protocols, etc. Stable coins, maybe meme coin trading, maybe other type of trading. But the more activity, the more gas fees, the more Bitcoin yield there will basically be.
Awesome, thanks. And yeah, Brendan.
Yeah, I like that. I think similarly with Core, the yields will also come from transaction fees and gas fees. But as mentioned, the way that we set up our tokenomics on chain with a native token of Core, right? So Core is the native gas token. Bitcoin is one of the things you can do to stake and help secure the chain. So right now, as mentioned, we have about 5,000 Bitcoin staked. Yields are about 5 to 8% annually, and they're paid in Core token. So some folks go take that yield, stake it, and earn higher yields on Core staking, or they sell it. You can think of our tokenomics as again, similar to Bitcoin, right? There's a fixed hard cap supply as Bitcoin, 21 million Bitcoin. There's 2.1 billion Core. And we have like about 40% of that total supply has been budgeted for block rewards, right? So they're kind of being paid out daily. Instead of a 4-year halving cycle, there's a small drop every year until eventually after 81 years, there's no more tokens left. So you can think of it as like we're basically paying for security or rewarding stakers and miners for helping secure the chain. Where the network after 81 years should subsist solely on fees and transactions, and hopefully well before then, right, to juice up yields. But that's where the yield comes from today. It's immutable, can't be changed, fixed supply, and therefore is very valuable yield. And I think the key thing here is there's going to be a lot of different things and approaches that come out. I don't know if I agree necessarily that this is all Bitcoin staking. I see it as like ways to put your Bitcoin to work. It's not necessarily staking per se. And they all have different trust assumptions. And I think that, the big question is going to be, where is the yield coming from? That's kind of the key question. It's like the funny saying, like, if you don't know where it's coming from, you are the yield. So it's just like, yeah, people will just be aware, and there's just going to have to be higher yields, I think, for these more difficult or more risk trust assumptions that you need to take on. But that's how it works currently with Core.
Cool, makes sense. And Edgar, I was curious if you wanted to maybe speak to some of the other protocols that Kiln supports, like how things work on Babylon, for instance.
So Babylon is a bit more complicated because you can think of Babylon as kind of like the eigenlayer for Bitcoin. So Babylon rehypothecates BTC in the form of economic security to potentially like a vast multitude of different protocols. So potentially you could have like one BTC securing hundreds of different protocols. But I think what you just have to keep in mind with Bitcoin staking in general is that you have one asset that is securing a protocol of which it's not necessarily like the native asset. So that means that in other protocols, if you stake Atom or if you stake ETH, for example, you will have a change in the ETH and Atom inflation. So there is basically a reaction process there. If you stake Bitcoin on a protocol, there will not be more Bitcoin inflated basically during that period. So you really have to understand that the reward come from an exogenous place basically. So that means that you just have to look at how much revenue the protocol is taking in. So how much fees are people paying? How much inflation of the native token is happening. You look at this broad revenue and you look at how much Bitcoin is being staked, and basically you have to understand that, let's say like I stake 1 Bitcoin and there's 100 total Bitcoin being staked on protocol A, then I will get 1% of the revenue of protocol A. So it's something to keep in mind, because Bitcoin is a very, very big asset, which means that basically you could potentially be a bit diluted by the potential mass of staked Bitcoin that could be performing the same action as you.
Awesome. Got it. That makes sense. Actually, Thomas, I wanted to ask, there was a question on the chat there. So as we heard from some of the other panelists, a lot of these yields are often paid in, a token other than Bitcoin. I'm kind of curious, what are you seeing from clients, institutions in terms of how attractive this seems? Yeah, I guess what are you seeing there?
With regards to staking in general, you get paid in the native asset, and that's pretty straightforward. Also, from a reporting perspective, we're actively trying to figure out how this would work for Bitcoin staking, or even Eigenlayer, right? To look at ETH. If you're getting paid in the ABS tokens, do we pay it out? Where does that conversion take place back to the native asset, whether it's ETH or BTC? Is there a market maker involved? Can BitGo be involved? what do the clients want to see? How does reporting all work, right? What pricing oracle or system do we need to use in order to build the clients appropriately for when they report? It's all pretty, I guess, in progress at the moment. But from what we can tell, and from what I can tell, speaking personally, just anecdotally, people just want it back in the native asset to be as simple as possible. They'll take the extra yield from all the other ABSs or other L2s for sure, but they want it back in the core asset.
Awesome. Yeah, that makes sense. Cool. I think related to that and a little bit kind of moving on, Thomas, I also want to direct the question to you, which is, what role does like Bitcoin play, in a portfolio, managing a treasury? Who is kind of Bitcoin staking for? Is it, will this be better for and more attractive for institutions, for retail, for everyone? What does that look like?
I think if anybody is long Bitcoin, and if all of a sudden there's a way to get an extra, 2 to 4% yield just by holding it, then you've created an entirely new economic paradigm on top of Bitcoin. You'll probably see the same types of DeFi apps being built that are just copied over from ETH, right? Just over to Bitcoin. Some use cases that immediately pop to mind, and again, this is not thinking about technicals or regulation or compliance, just what could additional yield on Bitcoin mean for certain users of Bitcoin and also certain clients of BitGo? One use case that comes to mind is for miners, right, who are natural sellers. Today, they mine the Bitcoin. Sometimes they have to sell it in order to pay for operational expenditures and costs, right? They pay their fees in USD or stables, or they collateralize against the BTC because they're long BTC and they borrow. But what if they can just sell the yield from the BTC and not touch the principal, right? Depending on how much they have, that could be an interesting game changer for them. If a Bitcoin has native yield, that could be a stronger collateral asset as well for traders who are looking to borrow other assets. And then, of course, if there's native yield on Bitcoin for ETFs, that's a whole game changer, right? If you're talking about potential dividends. Now, that's a whole separate topic, right? The SEC has its views on staking, but I'm just saying, like, it does open up the doors for a lot of new applications.
Yeah, that makes sense. Yeah, I was curious, Edgar, did you want to add anything there from kind of Kiln's perspective?
I think all was said. I agree with what Thomas was saying.
Cool, makes sense.
Sorry, one last thing to add.
Seems...
One quick thing to add. I think the difference between Bitcoin holders and ETH holders is I don't know how many of them are willing to participate as much in these points scheme as ETH holders in DeFi. That's to be seen. I'm not closely monitoring it, but just from the institutional perspective, I think it's less attractive.
Sorry, Brendan, you were saying you want to add something?
Yeah, no, I mean, I think we'll jump into some other pieces after, but I think Thomas covered things quite well. If you have like what we call a risk-free rate to Bitcoin, which is never really been the case. Bitcoin's incredible. It's miner run, right? Miners are the ones making decisions based on hash. There's never been a native yield necessarily. So if you have like a risk-free rate similar to what Ethereum has, I think that's very interesting to a lot of folks that are just trying to hold Bitcoin for the long term, right? Why not put it to work, especially if it's risk-free? So I think with some of these non-custodial approaches, it's a bit of a no-brainer, even if the a lot of Bitcoin gets staked and the yield percentages go down. And then if you're looking for higher yields, you're going to have to put your Bitcoin to work or take some risk on. But I think the appetite for no risk, long-term holds of Bitcoin, most people have conviction in this long term, is kind of a no-brainer, right? And I think Thomas spoke to that really well.
Sweet. Awesome. So actually, I wanted to direct a comment to the audience. Like pretty soon here, we want to like jump into Q&A. So if you all want to drop questions that we can all answer after, feel free to kind of start doing that. But yeah, I still have some other questions that I wanted to kind of get through on my end. So actually, Edgar, I wanted to maybe ask you, what does the current state of Bitcoin staking look like? What has happened over the past year and in recent times? Yeah, basically, what's the current landscape there?
Yeah, so I guess a big event for Bitcoin staking was the launch of native Bitcoin staking on Core about 2 months ago, where users could start to perform the staking action from the layer one. The Babylon protocol is in testnet. We're seeing a ton of layer twos that will integrate Bitcoin staking into their protocol, likely in end of Q3, Q4. For example, Bob and Mezzo is one of the few that we can talk about. And yeah, more broadly, like I think we can talk a bit later about like the broader development in the Bitcoin ecosystem, but I'm very, very bullish and optimistic about the demand for a layer one block space and the need for development on layer twos. And as we're seeing on Ethereum, layer twos rollups, they need services to perform as they really want to. You know, like if you're going to innovate on a layer two, you want higher scalability and a lot of things, and that demands specific services to be able to perform the way you want, basically, as a rollup. And I can include, for example, like sequencers, fast finality services, interoperability protocols, and all of these protocols, they will require some form of decentralized consensus. And the best way to get this decentralization is to leverage Bitcoin as a staking asset.
Got it. Makes sense. Yeah. So, I mean, it seems like the uses for Bitcoin staking can be quite varied. I'm curious if you went to like, I know you mentioned some of these different protocols that can be secured. I'm curious if you have any thoughts on, maybe are there broad types of these protocols that can be secured through Bitcoin staking? And then do you think there's any benefits and drawbacks? Or is that something that's still kind of evolving and developing? Edgar, did you want to like start off there?
Sure. I think that we will have to see like exactly like what type of protocols will use Bitcoin as security. We'll see like their exact demand for security. We'll need to study like their requirements for slashability of the Bitcoin, and then we need to understand like how the Bitcoin markets, how the Bitcoin holders react to these protocols, and if they want to, if they want to engage a lot in a non-risky protocol, for example, or if, for example, a Bitcoin staking protocol that could involve significant slashing will only probably get less than 100 million in Bitcoin TVL.
Got it. Makes sense. I want to like hear from Brendan and Willem as well. What's the current state of Bitcoin staking on Core and on Botanics? How have things like developed in the past year in recent times?
I can go first. So yeah, I mean, I think we can talk about where we're at today. So I think we're pretty happy. I think we were one of the first to come to market, and there's about 325 million staked at this point. We have capacity to take a lot more Bitcoin. Yields are pretty healthy, 5 to 8%. And I think what else is interesting is like we're talking a lot about staking, but I know Willem talked about this too, but we're actually a blockchain, right? So the chain needs to do well and have usage for this yield to be around 81 years later. And we're pretty proud of where the chain sits now too, in terms of TVL, dApps, Bitcoin use cases like money markets, DEXs, etc. So I think we're really happy with the progress. It's still new. There's a lot of questions around Bitcoin staking. So we're just kind of excited to get the ball rolling there and been really happy with the progress so far. And then things that we're seeing that I think are also interesting are these seeing a lot of restaking protocols. I think we've talked about that. Edgar touched on that a little bit. I think they need to find. There's a lot of Bitcoin, so need to find the supply and the yield to support all this Bitcoin because there's just so much liquidity. But excited to kind of see how that turns out, and then also interested in these LSTs. Obviously, we have BitGo here with Wrap Bitcoin. There's obviously a pretty interesting opportunity. I've seen a lot of projects looking to tap into Core's yield. or other yield sources and have some sort of LST token on chain where there's like a native yield built in with the bond layer, and then you could deploy it into DeFi. There's already, I don't know the last wrap Bitcoin or Bitcoin derivatives, but it's something like 20 billion or so, 20 billion plus. If you add them all up, so that's quite a bit of liquidity there that can come in and be deployed into TVL or money market. So excited to see those developments, seeing a lot of those folks pop up as well that are kind of building on top of Core's yield, but obviously different trust assumptions. But it'll be interesting to see how that plays out.
Yeah, I'll chime in here as well. I think when 2 years ago I was writing the Spadachain white paper, I think there were very few ideas around Bitcoin staking, maybe just like a white paper from Robin Linus, actually, I think from 2020. And yeah, it became quite clear to me very quickly that Bitcoin is, as a pristine collateral, is the most suited to actually run a staking protocol. And yeah, it's been incredible to see that actually play out. I think a lot of people underestimate how much still needs to be built. Of course, a lot of things are open source. You can pick pieces and here and there, but like when you actually want to make breakthrough technologies, like it takes quite a lot of building time. But I'm actually super excited. Like we're code complete with Botanics, and I'm soon going to mainnet with 15 different validators. So we'll be immediately decentralized from like day one, which is like unique in the layer 2 space. There's no one else that actually can do that. We'll have a massive ecosystem. So I'll actually see a lot of those gas fees, and actually we hope to break through Bitcoin DeFi because it's just a massive market on its own. We have the potential to actually do that. And so from what I see from my perspective, I think the next 6 months will be absolutely incredible. Like Bitcoin DeFi, Bitcoin yield, these are all things that people have been talking about for years. But I think it's finally happening. I think it's finally there, and that will bring so much activity back. Finally, we can make the jump from Bitcoin being a store of value to actually being a medium of exchange, and that's just massive on its own. So yeah, very excited about the next few months. I think the yields, like we talked about, will be between or at least higher than 5%, which makes sense as a risk-free rate. We'll have the yields in native Bitcoin on Botanics, but there will be so many different options. Differences between the previous cycle is that this is all open source. This is all permissionless. This is all run by blockchains and no longer centralized parties where you don't know how they get yield, or if it's just a centralized Ponzi scheme like we've seen before. So yeah, this is exciting. This is exactly what's needed in the world, I believe, and some quite big breakthroughs. I think in general, a lot of people have talked about the last 4 years that there haven't been any breakthroughs in the whole of crypto. Like you have a lot of the different protocols and dApps that have been just using the same code, and besides DeFi Summer, there haven't been massive protocol or dApp breakthroughs. But the Bitcoin staking is definitely one. It's very early stages, but this can play out to be very, very big.
I just want to quickly add to Williams. I echo that sentiment 100%. I always thought, I think a year and a half ago, when Silvergate and all those banks started to go their meltdown, right, and FTX, I was thinking, what does the next DeFi Summer even look like in 3.0? Will it ever happen on Bitcoin, right? And now it certainly feels like it's happening on Bitcoin, DeFi Summer 3.0. From a Bitcoin perspective, from my perspective, I would say we view it like a two-sided marketplace. There's a supply side, which who holds BTC, whether it's the custodians or self-custody. There's ways to find those inventory, right? With wrapped Bitcoin, there's about 10 billion TVL. What I'm most curious about is what does the demand side look like? Who's, for Babylon, for example, who's actually asking, which proof of stake chain is asking for the economic security of how Babylon's architected it? And then for CoreDAO and for Botanics, what are all the dApps that are creating real use cases, right? That'll help propagate that real yield. So that's what I'm most excited about and looking forward to, that one killer use case.
Awesome. Yeah, it makes total sense. I think we're all kind of looking forward to see what kind of emerges there. I think to close us out, and I think I'll just kind of mix some of the questions that we've gotten from the Q&A here. I want to talk a little bit about the future outlook going forward. what Bitcoin kind of staking looks like, what's coming in the near future and in the far future. Edgar, yeah, I wanted to maybe see if you could wanted to like get us started here. Just, what do we see as some of the upcoming tech developments or trends kind of that will shape the Bitcoin landscape? And I know we talked a little bit about risk taking. There was a Q&A question about risk taking on Bitcoin. What does that kind of look like?
So first about the technological developments on Bitcoin, one thing I'm personally very optimistic about is an opcode called OP-CAT on Bitcoin. And basically this is an old opcode that used to be in the Bitcoin code that got taken out by Satoshi in 2010. And that basically allows in the Bitcoin code to concatenate two objects. And long story short, this is something that could potentially stifle a big wave of development in Bitcoin. And one of the things that could come with OP-CAT is the development of zero-knowledge rollups. And as you know, zero-knowledge rollups is one of the most promising rollup technologies. And I think that OP-CAT could really boost Bitcoin's modular expansion, where we could see like many different rollup stacks and potentially like thousands of rollups, thousands of different layers built on top of Bitcoin. And like I was saying before, all of these rollups, they will need services and they will need security from different protocols. And I believe that those protocols will be leveraging Bitcoin staking. But yeah, that was what I was thinking about. And yeah, going back to your point on restaking, I think it will make sense for all of these protocols to tap into like a specific marketplace to go and get this BTC economic security.
Got it. Makes sense. Yeah, I was curious. Actually, Brendan, I was gonna shoot it over to you. Yeah, any exciting developments on the pipeline?
Yeah, I think all that's very interesting. Definitely watching these trustless bridges. All these side chains, including Core, we have trust minimized bridges, so like over collateralized bridges, etc. But if you see something like this come to fruition, it's going to be pretty awesome to have trustless bridging or trustless scaling and have a lot more liquidity flow into these ecosystems. So I think a lot of people now are staking their claim in a way, trying to build out an ecosystem and get the right builders and preparing for that moment. The other thing I see down the road is I think yield will become the norm, frankly. Like I think every exchange, custodian, and frankly, ETF down the road will have some form of yield baked in. And it'll probably be a variety of providers. Like we've got, Core and Botanics here, and we mentioned a few others. But yeah, I think that's honestly just going to become the norm. We actually already launched an ETP in Europe. So it's like a yield bearing Bitcoin product where you can buy Bitcoin that's yielding 3.5% a year from a brokerage account. Super cool. And I think that's going to be kind of become the norm. And then for folks that are custodying with BitGo, I think they're going to get used to yield. And then, if you're custodying yourself, you're going to have options to yield too. I think that's honestly just going to become the absolute norm, especially when there's risk-free options and non-custodial options like Core offers. So pretty excited about that. And I think that that kind of just unlocks a whole new use case and honestly energy into the Bitcoin space. Willem fired me up a bit there, talking about Bitcoin. So I think it's nice to see this kind of new energy coming into the space, and we're all pretty hyped about unlocking more use cases for Bitcoin.
Yeah, Willem, any comments there? Anything maybe particularly around Botanics, upcoming developments?
Yeah, no, absolutely. I think I'm less excited around rollups, as I think that's more a layer 3 technology or restaking, because that's still like not fully proven even on Ethereum. But what I am absolutely excited about and what you start seeing happening is building that permissionless open financial system on Bitcoin as the money. And we've seen that play out on Ethereum, but now you can actually, or soon you can actually do that with your Bitcoin. Think about perpdex or perpetual trading, very active on Ethereum. We don't have it on Bitcoin. Soon you can have that. It's copy paste. You can start having that with Bitcoin as your native asset. I mean, when you think about borrowing, so many people, actually a lot of Bitcoin maxis over the last few months have been asking me like, yeah, I've got so much Bitcoin, but I want to buy a house. How do I do that? I don't want to sell my Bitcoin, but what if you can suddenly borrow against your Bitcoin? Or you can launch a Bitcoin-backed stablecoin. Those are applications that even today, okay, you can do it on wrapped Bitcoin with additional trust assumptions, but if you can do it natively on Bitcoin, those are game changers. And that is actually the world that I try to work towards. When you think about a world 10 years or probably like more close to like 50 years from now, you can actually have a world where Bitcoin is a reserve currency in the world, where you have lending protocols, borrowing protocols that replace banks, where tokens are the new type of stocks in the world, where you have decentralized exchanges to trade those stocks. That is a world that is open 24/7, more permissionless, and a way fairer world with Bitcoin as the perfect money in that. And so I can finally see those places coming together, where you actually have a full world running on Bitcoin as the money, where you have a better financial system with decentralized exchanges, with perpetual trading, all open, permissionless for anyone in the world, where everyone can launch their own stocks, where everyone can launch their own tokens. I think that's a very exciting world that we're working towards. And so having those applications and those possibilities come to Bitcoin is what I'm most excited about. Suddenly lending against your Bitcoin, getting that Bitcoin yield. That's actually like we're fast running the financial system that we've seen from like the 1900s until like now, the traditional financial system, and we're running that or rebuilding that in an extremely fast pace in the world of crypto. And now over the next year, we'll see that happen on Bitcoin. That is, yeah, by far the most exciting thing.
Agreed. No,
And
super
that is
excited
also
too.
the alpha on what we're working on with Botanics. We'll see that soon in a few months, hopefully pay out.
Yeah, can't wait. And yeah, that's an exciting kind of vision for the future. I think, yeah, Thomas wants to see if you wanted to close us out here, any thoughts on what's coming, what the future looks like, and any thoughts of what it looks like for institutions or people using BitGo for custody.
Yeah, absolutely. So I like how you ended up BitGo for custody. At this point, we actually do so much that it's easier to describe what we don't do. So we're not an exchange, we're not a market maker, and we don't have our own chain, right? But we're certainly in the game of keeping up with the developments and how the crypto market evolves. Because if you look at how Bitcoin evolves, it mimics the crypto ecosystem evolution over time. So you start off, just quick recap, 2013 was like hot wallets. 2018 was regulated cold wallets that were insured and secured. And then people, after they kept their money in the cold wallets, they're like, hey, how do I utilize this? How do I trade? How do I earn yield? So then we enable staking and trading. I think going forward, what you'll probably see most likely is some form of TradFi prime brokerage model being built on top of custody. So your assets are there, but you could do a lot more with the assets, whether it's keeping it there to stake, keeping it there to trade on different venues outside of BitGo, right? While you settle it off chain. There's a whole kind of spectrum of different applications we're building for institutions to be more active in crypto digital assets, Bitcoin specifically. Now, if you ask me about the concept of institutional DeFi, that's a trickier topic, and I think it's been trickier because of regulation. And it doesn't seem like the market really rewards stuff that's not completely open. If you try to partition it off for just institutions, there doesn't seem to be much adoption. But that being said, I think there is a world where when you have the right incentives in place, it's almost too good to pass up, and liquidity wants to be free, and it'll figure out a way to realize that.
Awesome. I think that's a good place to kind of close us out. So I think we can wrap it up here. And yeah, I think we covered all of the kind of Q&A questions. So yeah, I want to kind of thank all the panelists. It has been a super interesting, fascinating discussion. I think we've all learned a lot about Bitcoin staking and what the future holds for us. Before we wrap, just want to direct the audience to a few resources so you can follow up, learn more, and learn more about the panelists here. So Kiln has a great post written by Edgar on exploring Bitcoin staking, the key players and ecosystem insights. So you can use that title to look that up there. Super good post. And yeah, definitely feel free to follow Kiln on socials, on X at Kiln_. Finance, and on LinkedIn as Kiln. And also, I invite you all to like check out Kiln's BTC staking talk at ETHCC recently, titled "Using BTC Economic Security to Secure New Ecosystems and Use Cases." Great talk there. You can learn more about Core at coredao.org, about Botanics at botanicslabs.xyz, and about BitGo at bitgo.com. So yeah, thanks everyone for participating. This has been super interesting. And
Thanks for having us.
see you later.
Yeah, thank you. For those
Thanks
in
all.
Nashville this week, in person.
See you in Nashville. Thanks. Bye.
Yeah.
Thanks a lot,
Bye,
guys.
everyone.
Bye.
Bye.